The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
All right, welcome to another episode of the Multifamily Masterclass. I'm Jamison Manwaring, CEO of Neighborhood Ventures, and excited to have Heidi Butler, our head of finance, and Bart Dill from Investor Relations joining us today as well. Hey, guys.
Hello.
Howdy.
So we're going to jump right into it with some really important insights about what's happening with the multifamily market nationally. So there has been a lot of new apartment units coming onto the market across the country, including in markets like Phoenix. This was driven by low interest rates a few years ago, and these projects were started a few years ago, and now they're just getting completed. And so we're seeing some markets as this new supply of housing come on the market, that rents and occupancy have come down. Phoenix was the number one market last year with over 20,000 new apartment units that came on the market, so we had a lot. But things have actually stabilized pretty well in Phoenix, and we're going to look at the list of the top 10 markets that have the worst apartment occupancy, and I'm just going to give a little sneak peek. Phoenix isn't on that list, and that's a good thing for us. It's important to kind of know what's going on, and that is one factor that can impact multifamily is the supply of apartment units that are available, and that the new construction of those units as they come on, just with what we learn in Econ 101, supply and demand, as more supply comes on the market and the demand stays the same, then the price goes down. And the inverse is also true. As demand stays constant and supply goes down, price moves up. So we're going to look at some of these worst occupancies in some of these worst markets. And this is according to RealPage. So the worst performer in May as far as occupancy was Myrtle Beach, and vacancies in Myrtle Beach were at 90%. So that's pretty low with multifamily. So if you're looking at different types of assets, 90% occupancy might sound good, but for multifamily, that's pretty low when you're looking at from a macro view. So number one was Myrtle Beach. Second to that was San Antonio. So we hear, Texas is a great place to invest. Everything in Texas is going to grow and just keep going up. Texas, their occupancy is now down to 91%. Augusta and Baton Rouge, which is at 91%. And then that's followed by Memphis, Jacksonville, Colorado Springs, Cape Coral, Fort Myers, Corpus Christi, Shreveport, Lubbock, and that rounds out the top 10. Those were the worst, but all major Texas markets, Dallas, Fort Worth, Houston, and San Antonio's had occupancy of less than 93%. So what's happened in Texas over the last several years when it comes to multifamily is there's been too much building that's gone on there. There's a lot of new apartments that have come onto the market, and that does impact occupancy. And the other thing that I would point out that stands out to me is a lot of these are tertiary markets. They're not core markets that have large population centers. They tend to be a little smaller cities out in the outskirts, and those are the markets that tend to get a little soft when it comes to occupancy.
Yeah, if you were to have me guess what were the top five, I would have guessed some of the bigger cities like San Francisco, LA, New York. But given the amount of people that live there, and there's really not a lot of new construction in those places happening because there's so much development already there. So I would have guessed that. So it's surprising that you hear it's in the Gulf Coast and in places like Dallas, San Antonio, Austin.
Yeah, because those are the areas where people are moving from, moving from the Northeast, moving from the Midwest down south. But we have to remember those are also the areas where people are building new apartments.
Yep.
So if you get a little over your skis in the building and that supply gets oversaturated, this is what's going to happen.
Well, I think another part of it that we're not even discussing is job market. And, a couple of these places I'm thinking of from your list there potentially had some bids out for some big jobs at the plantations, things like that were going to head out that direction. Ended up moving into more core areas. That's a huge factor if you're looking at building in that area and all of a sudden 10,000 jobs aren't going to be there anymore. That build is still there. Those jobs aren't.
Yeah, and those, you have to follow the jobs. If you want to look at growth and migration pattern, you have to see where jobs are going. And, some of these markets, this might be a temporary thing, but it's something to be aware of as a multifamily investor. You're always looking at that supply demand. We're glad Phoenix isn't on there. And we're actually starting to see Phoenix recover, even though we were number one with new supply last year. And frankly, it's because the growth in Phoenix just continues. And all of the new companies who continue to come here, we're starting to see a leveling off in occupancy. And now as we kind of turn the page on the other side of this story around supply, and we get out into 2025 next year and 2026, 2027, there are real concerns among housing experts across the country that because of where interest rates are at, new housing starts and new multifamily starts of construction have plummeted. And as you get out to 2026 in particular, it's very clear that all of this excitement that created all of these new apartments, that's gone. All of these low interest rates that really drove that demand, that's gone. Interest rates are now high. And so what has happened is new construction of apartments and multifamily units falls off a cliff as we get into 2026. And one of the biggest critics of the Fed is Barry Sternlicht. He's a very known real estate entrepreneur and investor, and he loves bashing on the Fed. I think it's one of his favorite activities. You can at any given time see him tweet or have an interview on CNBC where he's bashing the Fed. But his latest thing is that he has said Jay Powell, who is the Fed chairman, and his merry band of lunatics they are doing a self-inflicted suicide when it comes to housing prices. So Barry's point is that his policy has now crushed multifamily starts, and we need houses. He says with only 220,000 houses coming in 2026, I guarantee you rents will go up. And so Barry's pointing out that the demand is going to stay high, but because interest rates are so high, entrepreneurs are not building. Home builders are not building. Companies like his that build commercial real estate and multifamily they're putting the brakes on things, and the rents are going to be moving up in 2026. We need both houses. We need more houses. That's why even as interest rates went from 3.5 to 7.5, housing prices stayed high because there's not enough houses. And that's also why rents have stayed stable even with all this new supply of houses. It's very clear to people who look at the numbers, we need more housing units. And, part of this with Barry is he likes to jab, and he's probably never happy no matter what the Fed does. But at the end of the day, his point is that rents are going to be moving up. People aren't going to like that, and rent is part of the inflation factor. So that will start to move inflation up in and of itself because there's not going to be enough housing units.
He's definitely on the more pessimistic side, but I mean, if you just take it for what it is, there's going to be less houses built because the cost to build things are way higher now. We already know there's going to be a drop-off in new units delivered to the market for multifamily. Where are people going to live? The demand is staying constant. So, I mean, yes, he has a pessimistic view on all this, but he's not entirely wrong.
And on top of the lack of supply, there's also challenges when it comes to expenses if you're a homeowner. Now, we don't want to be all doom and gloom, but we also, as investors and as folks who pay attention to what's happening, we want to look at the data and we want to understand how can we best prepare for what's coming. And this article by CNN and a lot of these news outlets, they'll put an article out like this, and the doom and gloom really gets clicks, right? And so this says the hidden costs of owning a home are surging for Americans. So maybe it's a little doom and gloom from CNN's part, but they do reference some things in here that I think are important for people to realize about owning a home. And it also points to why so many people decide to rent versus own. So one thing that they say is U.S. homeowners are now paying an average of $18,000 a year on property taxes, homeowners insurance, and maintenance. $18,000 a year. So if you divide that by 12 months, that's over $1,000 a month. It's like $1,200 a month just for taxes, insurance, and maintenance. That's the rent for a lot of people in our market on a one bedroom or a studio. And that's nearly an increase of 26% from 4 years ago when that cost was $14,000. So this has gone up a lot. Owning a home has gone up. The cost of owning a home has gone up a lot over the past couple of years. We know insurance has gone up a lot. We also know the cost to maintain and replace items in your home has gone up a lot. So there's a lot of things here when it comes to owning a home that make it tough to justify going out and paying high prices, high interest rate, and now your expenses to own the home have also gone up.
I think that points to two things in this article, but also just thinking about projections for the future. Number one, when you're in the market to buy a home, you know, when I look at homes all the time, new builds, I feel a little bit more confident in about maintenance and upkeep because I'm not dealing with a 100-year-old home that I'm trying to worry about all
Yeah,
the
you know what you're
the
getting
flaws.
when you buy
Yeah.
a new home. Yeah.
And insuring a new home versus insuring an old home, much easier. And that's something they talk about in this article is a lot of homes, due to weather circumstances, but also the age of a home, it's so hard to get insurance. And when you get it, it just spikes. It's incredible how high home insurance has gotten.
Yeah. Yeah, one person referenced in here said their homeowner's insurance, this is somebody in California. We know everything in California costs a lot of money,
Yes.
but their homeowner's insurance has doubled over the last 2 years without any notice.
They're just happy it wasn't canceled.
Yeah.
Yeah.
You have people in Florida who literally have gotten their homeowners insurance just taken away from them. One of the quotes in the article I actually thought was pretty funny was, a lot of first-time buyers think of the closing table as a finish line, but in another way, it's just a starting line for all these new expenses
Yeah.
that you're going to
Yeah.
Anyone who
accrue.
knows, who's owned a home before, knows when you sign, the expenses are just starting.
Yeah.
It's like signing up for a marriage and thinking you're good to go. Yeah, that's a funny way to look at it. And you know, the other thing with buying a home, if you buy a new home, there's a lot of advantages, but one of the disadvantages is every other home on the street probably looks like yours.
Everything. Yeah.
So it's hard to justify buying a home right now. Some of the home builders, they have good projections through this year because frankly, there's just not enough supply, but their costs have gone up and to build, and now seeing what's happening with the other expenses of owning a home, it gets harder to justify that over time.